Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Man, it looked like Tuesday was going to be a lot better than it ended up being. I mean, it wasn't awful. No move upward, but a really kind of negligible move by the 10-year, down 0.4 of a basis point. Not even a full basis point. I think a lot of optimism about Iran kind of faded and just, I don't know, maybe no one wanted to make a move before the CPI report, which is out later this morning. That's going to be big. And then we didn't see a huge move with regards to mortgage rates, according to Mortgage News Daily. I think it was, what did they have them? Was it, for some reason, it doesn't load properly on my laptop. All right, it was either up a basis point or down a basis point. I can't tell. By the graphic for some reason. For some reason, the website is not loading on my MacBook. It will load on my desktop. It'll load on my mobile phone, but it will not load on my MacBook for whatever reason. I have no idea why. But basically not a lot of movement that we saw on Tuesday. And I think a lot of that was earlier in Tuesday, like midday Tuesday, we were hearing reports that Pakistan was saying that the U.S. and Iran were close to a deal. And that always is going to move rates in a positive direction. And then by the end of the day, who was it? It was newly appointed, because the other guy probably was killed. The Strait of Hormuz will remain closed as long as the U.S. does not change its behavior and accept Iran's conditions to end the war, according to the newly appointed Secretary of Iran's Supreme National Security Council. So, and then Trump was like, you got to meet our demands. And so they're battling about demands. Doesn't look like they're any closer to a deal. So the optimism that we saw maybe earlier in the day dissipated by the end of the day. And so that's why we saw really very little movement in the bond market. Or maybe people just didn't want to make a move before the big CPI report. We don't really know. But welcome, everyone, to the Wednesday edition of Wilmington Mortgage. That was my longest intro I think I've ever done before I got to my name and show name. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer, Town Bank Mortgage, right here, Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday, unless, of course, I just take a month off for whatever reason. But I'm not doing that right now. So, yeah, no real movement in rates. Iran optimism out the window, get rid of that. So let's talk about, because we actually did get some very interesting data, I thought. So let's talk about that. So the first one that I think would have had some of the most immediate impact on the bond market, I mean, mostly because it was a Treasury auction. So that's just selling bonds. That's going to have an impact. And it was a very, very strong 3-year Treasury auction. Now we have a 10-year auction later today, so keep that in mind. But yesterday we had a 3-year Treasury auction that by all accounts was pretty strong. So the 3-year auction stopped at a high yield of 4.291%. That was below the 4.296%. That was the when issued yield, which basically means where was the bond trading when the auction began. And so when you have a yield of the auction that is lower than the yield that is currently available on the market, that is called a negative tail or a stop through. And that is actually a sign of a strong auction, strong demand, because people were willing to take slightly less than was available on the open market. So that was the first sign that it was a pretty strong auction. Then we had the bid to cover, which is basically kind of looks at demand, what people are demanding versus what they're actually able to get. In this case, the number was 2.71. That was the bid to cover ratio. A higher number is better The last auction, 2.6, so well above that. And in fact, that 2.71 was the highest bid to cover ratio since November 25. So pretty good by all accounts. So the two major components showing strength. And then we looked and broke down the bidders. So you have indirect bidders, direct bidders, and then primary dealers. Indirect bidders, a category that includes foreign central banks and other international investors, was at 64.2% of the auction. That was a drop from 68% the prior auction, but was still the third highest share of this year. And I think that what's going on with Japan, with their currency concerns, the fact that, we were worried they were going to be selling treasuries, better yet not buying. They are the largest holder of U.S. debt. And so the fact that they're kind of trying to figure out their currency situation and need to free up capital to possibly buy yen on the open market and these FX trades or exchanges, that could maybe make them pull back on their treasury purchases. So letting some treasuries run off and maybe not fully buying more. I would bet that's probably one of the reasons why we saw a drop in the indirect bids. Direct bidders took 24%, which was down slightly from 25% in July, and is roughly in the middle range since across this year's 8 auctions. I think it was like fourth. It was like right there in the middle. So 2 of the 3 major categories signaled a strong auction. I think I saw like a B+ was what the rating was by many economists on how the auction was. So that's a positive sign. Now, that auction did happen in the middle of the day when we were seeing some optimism in the bond market. So that definitely helped. So we will see if that carries over into today's 10-year. But a strong 3-year auction is nothing to ignore. So that is definitely a good sign. And then we got a report, or I should say we got this report first. That was actually the last data point that we got was the Treasury auction. Earlier in the day, we got a look at household debt. And, household debt's important because usually leading up to an economic recession, debt levels start to rise, right? Because all of a sudden, people are borrowing more money to continue their lifestyles, and then eventually it catches up to them, and then we have a recession, worst case scenario, a depression. And so household debt is an important factor to look at. And the New York Fed released their monthly report. However, in this case, they were looking at the end of the second quarter, June, and the data was solid. I mean, this was a pretty good report. Household debt was actually declined, or it did decline in the second quarter. In fact, this was the first time that we have seen a decline in quarter over quarter since the second quarter of 2020. And we all know what was happening then. So that gives you a very interesting indication of kind of where we are from an economic standpoint. Like, kind of weird, right? I mean, you would think, based on some of the arguments that are being made, that, debt would be skyrocketing. Now, we do have to break the numbers down, and they're not as good when you break the numbers down. For example, mortgages actually drove the decline, with outstanding balances falling by $74 billion. Student loans were also in the red with a decline of about $7 billion. So, are people paying off their mortgages, or kind of, what's happening there, that we did see mortgage debt decline? Maybe a good sign that people are paying off their mortgages. Hard to know. But what is a little concerning is some of the categories that did move higher. For example, auto loans increased by $28 billion. HELOCs climbed by $13 billion. Now, both those loans are not as good as a home loan. Well, maybe a HELOC is, because you're still talking about an appreciating asset. An auto loan obviously is a depreciating asset, but it's at least still secured to something. So those did rise. I mean, they're worse debt than, say, mortgages, but still secured loans. And then unsecured loans would be credit card debt. That rose by $21 billion. So that's a little troublesome, no doubt about that. But borrowing activity did remain healthy. Mortgage originations were relatively steady at around $505 billion. Consumers took out $211 billion in new auto loans. Credit card and HELOC borrowing capacity continued to expand as well, but nothing raising any red flags. Now, there was a part of the report that did get a little bit of negative attention, but it wasn't as bad as a lot of doomers on Twitter and YouTube and elsewhere are going to jump on this stat and say, ooh, watch out, be careful. And so we're going to give you a little heads up on that, on why it's not as bad as it seems. So the share of balances of delinquencies climbed from 7.6% in the third quarter of 2022 to 12.8% in 2026. Now, we have not seen levels like that since the Great Recession. So on its face, that seems pretty bad. Like, here we go. Credit card balances are rising. We're seeing, debt rising. People can't make their payments. Delinquencies are rising. Here we go. Here's the recession. Here's 2008 all over again. Well, not really. So some of the New York Fed researchers looked at what was causing this climb, and they concluded that the higher delinquency rate is largely the result of old charged off debts remaining on lenders' reports longer than a surge in new delinquent borrowers. So it's not new people being delinquent. It's these older reports that are staying on their credit reports. And in fact, they noted that I think from 2011 to like 2020 or whatever, that it was like 40% or 30% or something of debtors or, credit card companies or whatever, lenders, were holding on to that, delinquent debt over a year. And they said now it's 80%. And so what's happening is these lenders are holding on to this debt and keeping it on their books for longer. And that is really what is causing that climb versus a concern about an ever increasing and growing number of delinquencies. It's more about them not dropping them off their books like they were before the Great Recession. They clearly changed that after that, and now they've kind of gone back. And so that's why I've seen the number rise. But by most accounts, this looks like a pretty healthy economy where the economy's growing and debt grows. I mean, because that's, there's a really fascinating chart I saw on Fred, and it was debt, household debt in relation to GDP. And that chart is like this. And it's funny because a lot of these doomers, they'll see like total household debt rise and they go, oh my gosh, this is the most debt ever, where the things are about to collapse. But they remember everything's relative, especially when it comes to economics. And so, it's kind of like the old joke, right? Where if you owe the bank $1 million, you have a problem. But if you owe the bank $100 million, the bank has a problem. And that, it's kind of like that, where it's, if we're talking about total household debt and we're like, oh wow, it's 18 trillion, but our economy is a $36 trillion economy, it's 50%. But you look at another country and you're like, oh wow, they only have $2 trillion in debt, but their GDP is 1 trillion. So you're like, that's worse. Even though the total number is smaller, that is actually worse. And so by all accounts, I don't see any evidence there's anything to be worried about with regards to some over debt problem. It's not in the data, is what I'm pointing out. All right, before we go, existing home sales, got to talk about what's happening in housing. Existing home sales slowed as expected. Doesn't change the fact that they slowed, but at least economists were projecting it. Existing home sales fell 1.7% in July to a seasonally adjusted annual rate of 4.06 million, lowest level since April. And like I said, matched what economists were expecting. If you're looking for a silver lining, sales were up 0.7% from 1 year ago. So a little better. And then it was a very mixed month regionally. So the Northeast was the only region to be in the green. They were up 2%. The West was unchanged. And then we saw sales in the South and Midwest fall 3.1 and 2% respectively. So very mixed month. More negative than positive, hence the overall negative number. Surprisingly, though, this is another reason why, going back to this, here comes 2008 all over again, inventory levels fell. I mean, this is what's so funny about this housing market. And when anyone talks about it being 2008, it's like people are listing homes and saying, I want this amount. And then they don't get it. And then they pull the house off the market. Now, in 2008, people were listing homes, didn't get it, dropped the price, didn't get it, dropped the price, didn't get it, dropped the price, didn't get it, dropped the price. And then eventually the bank took it. That's 2008. That's not what's happening right now. And so the fact that we're seeing sales fall along with inventory, once again, is very different than 2008, where sales, inventory, that's what was happening in 2008. So overall inventory fell 1.9%, so actually more than sales, to 1.54 million. However, it's still the second highest level of homes in the past year. And because sales did decline, the month supply rose to 4.6 months, which was the highest level since August 2025, so almost a year. So, I mean, it's not to say that we're not seeing slowing in the housing market. We are. I mean, sales are down, no doubt about that. But the fact that inventory is dropping while sales are dropping is just so funny when people compare this to 2008. Very funny. All right, we got to go. You guys enjoy your Wednesday. Big day. CPI out, 8:30 a.m. Could be big. Could be good. Could be bad. Could be nothing. We'll see. We'll talk about it. And then the 10-year Treasury auction, also a topic of conversation for tomorrow's show. But you guys, like I said, enjoy your Wednesday. We'll be back here Thursday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.